Hello investors, welcome to Simpli Stocks. Since the beginning of this year, we have seen a sharp correction across almost all solar manufacturers, right from Waaree and Vikram to Websol. Many retail investors are stuck in these stocks and many of them must be feeling stressed as well. That is why in today's video, we will discuss solar manufacturing companies and try to understand why there has been such a sudden fall in these businesses. How is the sharp rise in silver prices affecting solar companies? We will also discuss what other challenges are we seeing in the sector. We will also discuss whether this correction is an opportunity or if the risk in the sector is increasing. And lastly, what should be your approach? The flow of this video will be as follows. First, we will understand the three key reasons due to which we are seeing this heavy drawdown. After that, we will analyze how serious these risks actually are side by side. We will also look at solar companies and how they are managing these problems or risks. So let us quickly get started. But yes, as a standard disclaimer, none of these stocks will be buy or sell recommendation. Please keep that in mind. We have covered solar companies multiple times on our channel, so we will not go into details again. But if you want to understand any solar manufacturer properly, you must have at least a basic understanding of solar module as a product. So a solar panel is also called a solar module, and a module is manufactured in 5 steps. From polysilicon, ingots are made, and then wafers are made, followed by solar cells, and finally modules. Many solar cells are put together to make one solar panel. Now, the reality is that in India, most of the companies import solar cells from China or Southeast Asian countries, assemble them here, and sell them as solar panels. Very few companies actually manufacture solar cells domestically. Currently, few companies like Premier, Waaree, MV, and Websol have cell manufacturing capacity. Even Vikram Solar does not have operational cell capacity. Similarly, many microcap solar manufacturers also do not have cell capacity and they have to depend on Chinese imports. But China is an enemy country for us, right? From an energy security perspective, it is extremely important for India to become self-reliant in solar manufacturing. That is why the government is providing strong support to solar companies through ALMM 1 and 2 or approved list of models and manufacturers, which includes Indian module and cell manufacturers. Under ALMM, if you want to sell or supply panels for any government solar schemes, whether it is rooftop solar scheme or PM Kusum scheme for solar irrigation pumps, you can supply only if these panels are made using Indian solar cells. Because of this, a very large demand supply gap has emerged in the market. Indian solar cells, also called DCR cells, are in high demand, but their supply is limited. Because of this, Indian solar cells are being sold at very high prices, and companies that already have their own cell capacity are selling cells at high profit margins and making a lot of money. That is why we have repeatedly said in our Simply Stocks community and on this channel too that a good solar company is one that already has its own solar cell capacity. Companies that only assemble modules do not enjoy such high margins. As you can see in this table, Vikram Solar does not have operational cell capacity and its EBITDA margin is the lowest in the sector. Premier and MV have EBITDA margins of over 30%. Waaree has recently commissioned cell capacity and its margins are gradually expanding. In Q3, Waaree's EBITDA margin reached 26%. But here the risk is, and this is the first reason why these businesses have corrected, as more cell capacity comes in India, DCR cell prices will start falling. The extra high margins that cell manufacturers are currently earning will normalize. The same thing happened in China. Excessive solar manufacturing capacity led to oversupply and margins collapsed very quickly. Therefore, in the long term, there is a very evident oversupply risk where supply can exceed demand for solar cells and panels. And this has also actually happened with Websol. In Q3, cell offtake was impacted, which brought down realizations for them. That is why we have seen such a sharp fall in Websol's price. This did not affect Premier and Waaree because they don't sell standalone cells, they sell modules, which are largely insulated from short-term price movements as agreements are in place. And large investors and institutions of the stock market always look ahead. The market is already pricing this margin risk, and this is one of the reasons why these businesses have corrected so sharply. The second risk that has emerged in the sector is the sharp increase in silver prices. Silver paste is used in solar cell manufacturing, and nearly 25% of the cost of a solar cell comes from silver. Now, there can be two issues here. First, profit margins of solar manufacturers can decline because of silver. The raw material has become expensive. Second, if solar manufacturers increase module prices, power companies may delay their projects and wait for silver prices to cool down before placing orders. So, this can lead to slowdown in the sector. We will shortly discuss both these issues around cell prices. The third risk that has emerged recently is that some solar power companies are facing difficulties in getting their PPAs or power purchase agreements signed. This system works in such a way that after winning a site tender, the power company approaches the power distribution company and says it will set up a solar plant at a specific location. So both sides decide the price at which electricity will be bought for the next 20-25 years. Based on this PPA, the power company then gets a loan or bank loan and can start the project. On this side, once a project is complete, the distribution company then buys power from the power plant and sells it further to us or industries. These PPAs are not getting signed because distribution companies are saying that they currently lack adequate transformers, transmission lines, or say overall transmission capacity to deliver the electricity from power plant to consumers. So this has become the third risk that can cause slowdown in the sector. Now, humble request before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simply Talks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Let us come back to our discussion. We will now go through each of these three risks one by one, and I will also share my views or opinions here. So the first concern is the impact on margins due to falling cell and module prices. So far, all major solar manufacturers have reported their results, and conference calls with the managements have also taken place. All of them except for Websol have clearly stated that there is no currently pricing pressure and margins are stable. Even for Websol, the fall in realizations and margins was because of offtake. Websol also sells cells independently. In comparison, Waaree and all sell finished solar modules which are governed by contracts. So Websol saw a margin contraction, although management says margins will come back to normal, and this has nothing to do with long-term oversupply overhang, but it is what it is, and that is why the correction here is so steep. This demand supply gap is expected to persist for the next 1 to 2 to 3 years at least. India currently has 18.5 gigawatt of cell capacity, while annual demand is around 22 gigawatt. By FY28, DCR demand is expected to reach 30 to 35 gigawatt, while cell capacity will be around 28 gigawatt. Now, here is something very important that you must understand very carefully. The 18.5 gigawatt or 28 gigawatt numbers is installed capacity. The actual or effective capacity will be lower, and there are two reasons for this. First, most solar cells made in India right now are of smaller sizes called M10. However, installed capacity is measured based on larger and more efficient G12R cells. In simple terms, the installed capacity looks higher on paper, but India is not yet producing these big cells in big volumes. The actual or effective manufacturing capacity will remain lower for the next 2 to 3 years, as the companies will need time for transition from M10 to G12R cells. Secondly, under ALMM, around 55% of cell capacity is based on older technologies with lower efficacy. Once efficacy norms are enforced, such as minimum 22% efficiency, much of this capacity and many smaller manufacturers will become obsolete. So this is a big risk for small manufacturers. And again, cell capacity will exist on paper, but actual production will be limited. Third, while modules are easy to manufacture, see, cells require significant expertise. Cells are delicate, they break easily, and production ramps up slowly. So even after capacity comes online, production increase will be gradual. For example, Waaree Energies management stated that although their 5.4 gigawatt cell plant is commissioned, production will be ramped up in phases. Each new 1 gigawatt production line currently takes 4 to 6 months to stabilize. So even if installed capacity reaches 28 gigawatt by FY28, companies will take time to achieve full utilization. Demand supply gap will still exist. I am not saying that cell manufacturers' margins will always remain high, but this is a strong short-term cycle where some manufacturers are earning very high margins and generating a lot of cash, which they can reinvest for expanding into other parts of the value chain. That is why we have consistently said that a good solar company is one that already has operational cell capacity, not the one that will add capacity next year or the year after that. What matters is whether the company has cell capacity today or not. This is because companies are expanding rapidly, and module manufacturing has already become a low margin business due to heavy competition. Module prices have been falling continuously, and margins will decline further as capacity increases. The sector is being commoditized, meaning all players will have similar technology and similar products. Waaree cannot sell its panels at significantly higher prices than a Premier and earn extra profits. That cannot happen. So in the short to medium term, only those players will perform well who move quickly backward along the solar manufacturing chain, from modules to cells and then to ingots and wafers. Over time, even cell margins will normalize. I agree with that. And ingots and wafers will become higher margin segments or products, so to say. In such an environment, many players without their own cell capacity will struggle and destroy investor wealth. That I know for sure. Only integrated players with existing cell capacity will survive and can generate profits, which they can use to enter into new segments or say move backward into the integration or value chain. For example, Waaree Energies is building presence across entire solar manufacturing chain or solar value chain, from ingots and wafers to BESS. Unlike other sectors where we see smaller players are growing faster or have an advantage, solar manufacturing is a space where I believe large players who can deploy heavy capex and expand rapidly will always have advantage over smaller players. This will allow them to maintain healthy margins. That is why personally I am not very optimistic about Vikram Solar, because it currently does not have its own solar cell capacity. Its cell line will start in H2 FY27 and production ramp up will extend to H1 of FY28. So no one knows what margins and cell prices will be at that time. MV currently has 2.94 gigawatt of cell capacity, which is gradually ramping up, but its next capacity addition will come only by FY28. Its Q3 cell production was 412 megawatt. Premier will add another 7 gigawatt of cell capacity in H1 of FY27, and it remains to be seen how quickly production ramps up in Premier. Personally, I am most bullish on Waaree because it has ramped up production the fastest. As you can see here in this table, Waaree had the highest cell production in Q3. Its results have also been very strong, with sales and profits more than doubling year on year. Although Websol itself has a small allocation in my portfolio, but after Q3 results and con call, I'm not very hopeful about this. However, the key trigger here is that its 600 megawatt cell line has recently started operations, which can drive strong growth going forward in the short to medium term. So whichever solar company you are invested in, you must clearly know how much cell capacity it has today, how soon the next capacity is coming up, and how are they ramping up production so that it can continue to earn good profits. Moving on, the second risk is margin compression due to rising silver prices. It is not a major issue. Some manufacturers include pass-through clauses in contracts, meaning if silver or aluminium prices rise, order values increase accordingly. On the other hand, companies like Waaree book their raw materials as soon as they receive an order. Another important point is that the use of silver in solar cells has been reducing over time. Because of research and development, silver consumption has already fallen by about 68% or say nearly 70% over the last 5 years. At the current pace of R&D, it is expected to fall another by 40 to 50% over the next 1 to 1.5 years. Therefore, even if silver prices rise further, although silver has corrected a lot, the overall share of silver in solar cell costs will continue to decline. Here too, bigger players like MV and Waaree can spend more on R&D to reduce silver consumption compared to smaller players like Websol. Lastly, without stretching this video further, let us come to the third and final risk, that is PPAs not getting signed. So yes, the issue exists, but it is not very serious at this stage. Last year, monsoons, labor shortage, and transformer constraints affected transmission expansion. But these bottlenecks, I believe, will gradually be resolved. Solar manufacturers anyway receive orders only after PPAs are signed. So there is no company level uncertainty right now. This is not a major concern at present, but it should be closely monitored. If PPA signing continues to be delayed in the future as well, then slowdown risk can happen. Now, to summarize at the end, margin compression risk does exist and you should not be in denial about it. In 2 to 3 years, cell margins will start declining, and if supply expands aggressively, oversupply risk will also emerge. So either you can avoid the solar sector entirely, or you should admit the reality and view it as a commodity sector. If you are able to adopt this commodity mindset, you will be able to differentiate between good and bad players. The investment opportunity lies in the fact that due to this uncertainty, solar stocks valuation have become very attractive, and in some businesses which have good, let's say, cell capacity, their profitability is also strong and they are available at 20-25 P ratios. And now in the end, if this video was helpful for you and you did not like it earlier, please do it now, and you can also subscribe to our channel. Your support through likes and subscribe motivates us to bring more such high quality analysis for you every week. So I'll see you in the next video. Happy investing.